All right, so balance sheets, okay? Now, what I typically say when I say look into a company, and this is not going to be for ETFs or mutual funds, obviously, because those are going to be a broad array of companies. We'll cover that in a future lecture, so don't worry if you don't know what those are or you're unfamiliar with what they are. We're specifically talking about specific companies, okay? So in my opinion, blue chip stocks that you believe in, right? And these are in no particular order or not something that I'm saying to invest in. I will have an add-on lecture of companies that I'm paying attention to, but obviously pretty much any blue chip company is going to be a solid investment long term, assuming they don't go under, or you're not investing into a company that has a terrible balance sheet. But if you're looking at all these factors like I'm going to cover, this will make sure pretty much, and I don't want to basically kind of solidify it and say that it's a sure thing, but it will kind of give you the best opportunity and pretty much make sure that your investment is safe over the long haul. Okay, and keep in mind there's always risk in investments, but typically speaking, this is going to be a good rule of thumb. Okay, so when I'm talking about buying blue chip companies, and like I said, these are in no particular order. I'm not saying that you should invest in these. I'm just naming companies that you might recognize. So that's like your Walmarts, okay? That's like your Amazons. That's like your Teslas. That's like any company that you'd recognize that is a blue chip company. That's what I mean with a blue chip stock or a blue chip company, okay? So signs of a good and bad balance sheet when you're thinking about buying stock in a company, okay? Because like I always say, when you're looking into a company, you want to look into their balance sheets. It's going to be the financials of that company, and it's going to give you the best indicator of whether it's a good company to invest in long term, okay? We're not doing short-term trading, like I said. We're not flipping stocks or doing penny stocks or, day trading. That's a loser's game. That's a guessing game. We don't guess. We want a sure thing, okay? So first and foremost is negative earnings, okay? So when a company has negative earning balance, it basically means that it's losing money over a long period of time. Now, that's a very, very, very good indicator. I'll show you examples of that on the stocks that we're going to potentially look at here in a second, okay? So negative equity, okay? That's another big one. And negative equity is crucial, although I obviously use the negative earnings or the low to, or negative current cash flow ratio for me specifically because they're the most basic and they're the easiest to look at for most people. Although negative equity can be a bad indicator, obviously, of a bad balance sheet in a bad company, okay? So negative equity essentially is when the deficit of their negative earnings surpasses the amount of capital that company has, okay? That's a huge red flag, obviously, and signals that the company's in distress and you should avoid buying it at all costs, okay? So just keep in mind that if you happen to see somebody with negative equity and their negative earnings obviously surpass the amount of capital that they currently have, huge red flag, avoid it. Now, the two main ones and the two basic ones, like I said, obviously we covered the negative earnings, and if you don't get that, it's literally going to be super easy to show you on their balance sheet. Also, a low or negative current cash flow ratio, which basically means their current assets amount by their current liabilities amount. Now, I also like to look at not just the current cash flow, but the long-term cash flow as well. Those are the three main things that I look at, okay? So negative earnings, does it have negative earnings? Does it have, positive or negative current cash flow? And does it have positive or current long-term cash flow, okay? We've already covered what cash flow is. Now, how do you find the balance sheet of a company? Very, very simple, right? Let's say that you want to look into, Tesla's balance sheet, okay? You simply Google Tesla balance sheet, right? It's going to pop up with a bunch of different, websites that you can look at Tesla's balance sheet on. Now, I usually use Yahoo Finance, although there's a number of them. They all are going to have the very, very, very similar or identical data. So if you want to look at a couple to make sure, that's fine. Probably a smart decision, obviously, if you're investing your money into the company and putting a lot of money into it. But any balance sheet will do. It's going to basically pull up the numbers that are public, obviously, because these companies are public. And obviously, Yahoo Finance is a reputable one that you can look at, okay? So what do I mean by negative equity, okay? Now, if you look right here, equity and investments, so right here on the left is current, and this is long-term. Usually this is below, so it goes like current right here. Obviously, you can see the dates here, so if, by the year, so this goes here, and then typically the liabilities will be directly under, but for the sake of being able to show you in a PowerPoint slide like this, I obviously took the liabilities and I put them over here onto the right. But typically speaking, they're going to be below. Now, the negative equity, okay, is if you look at the negative equity right here, equity in other investments. So this company has positive equity, and they've had positive equity for the past 4 years. So in 2016, they had positive equity. 2017, they had positive equity, and 2018, and obviously 2019, and probably into 2020, but those numbers obviously aren't out yet for this specific company publicly, okay? So that said, that's a good sign, right? We've already covered, you want to look for negative potential earnings, okay? So their equity's clearly up. Are their earnings up? Now, if we scroll over here to their long term, right, on their liabilities, well, their retained earnings are clearly positive, and they have been, and they're slowly going up, which is obviously a good trend as well over the past 4 years. So they have positive retained earnings, they have positive equity, also good signs. Equity, earnings, we're good here. So let's look at their cash flow ratio, okay? Now, their cash flow ratio, you want to look at the basics, right? Assets versus liabilities. So let's look at their current, right? And then we'll look at their long term. So total current assets is literally outlined right here. It's also a good sign when they have a lot of cash too, but that's not something that's kind of like a blue chip thing that you look into. So it's a good indicator if they have a lot of cash. It just means they can spend into investments if they need to. So you're going to look at their total current assets, and their total current assets are 175. What are their total current liabilities? Well, if we look over here, total current liabilities are 69 million. Their total current assets are 179 million, roughly. So clearly, and you're going to notice this as you look at more balance sheets, this is a great company to invest in because they have such good current cash flow. Literally, they have over 100 million current cash flow, which might not mean a lot to you now, but as you look into more companies, you will notice just how good that actually is, okay? Now, if we look at their total assets long term, it's about 286 million, okay? We look at their total liabilities long term, it's about 184 million. So their current cash flow is great. Their long-term cash flow is also great. And basically where I'm getting these numbers is obviously Yahoo Finance, but why I'm saying that means a lot is basically it means that if the economy would go under, or if that company hits a low point or they need to adjust or something, they have the cash flow to do it, right? If you have a company, like a perfect example of this is like Tesla. And don't get me wrong, I'm not saying Tesla's a bad company to invest in. I'm just simply saying that their cash flow is typically poor. Now they're obviously, you can make money on them by investing your money into them long term, potentially, if you believe in it. But I personally like to go after companies that have good cash flow, because if Tesla were to run into an issue where, something adjusts, or they have a competitor that's outbidding them, or, a regulation that the government puts on them, or, the economy goes under and people aren't buying their Tesla cars as much anymore, they do not have the cash flow to sustain it over the long period of time. So they would potentially need to bring in more investors potentially to keep their company afloat, which would dilute your stock in the company, okay? So, or your shares in the company, okay? So just keep that in mind. I personally like to look at these three things. They're the easiest to kind of look at. So negative equity, although I don't put that much stock into it, it does matter. Negative earnings, obviously, or negative current cash flow. Obviously, this company is great in cash flow. It has positive equity and it has positive retained earnings, so it's a great company. Now, if you guessed Microsoft, you would guess that this company is correct. Now, I'm not going to tell you how much I have invested in Microsoft. I do have money into Microsoft. I love Microsoft. It's one of my favorite companies. If you look at their balance sheet, phenomenal. Also, it's got one of the best trends currently. Obviously, I'm recording this during the coronavirus, so I'm sure it's dipped significantly. I purposely don't look at my stock portfolios for that specific reason, because I don't want to get into a scarcity mindset. I'm simply investing money. I'm literally buying more and more stock because it's cheap right now and I'm getting it at a discount. I'm buying assets low. But the whole reason I'm telling you that is if you look at Microsoft's kind of graph on how they've gone up stock price over time, the most consistent I've ever seen literally of any company. So it doesn't really matter in a lot of ways, but it just kind of gives you an indicator of how consistent they've grown and how consistent they are. Now, the next one's an example of a bad company, okay? So if you look at what do you want to look here? So equity and other investments, it's positive, so that's not a bad thing, okay? It is positive, although it's super low at 321,000, okay? Now, if you look at their earnings, it's negative, so that's a major red flag. Their earnings are negative, so they're literally bleeding cash about 1.1 million every single year. Their earnings are negative 1.1 million roughly. Now, we need to look at their cash flow, because if they have a lot of cash flow, maybe they're going to do something about it. It's probably there's already two major red flags, being that the equity is super low, even though it is positive, and the retained earnings are negative. But let's assume that these were both good, so let's look at the cash flow, okay? Now, total current assets are about 1 million. What are the total current liabilities? Oh, bam, major red flag as well. Look, 3.3 million roughly are their liabilities currently, and their current assets are only 1 million. So this company is not only bleeding money, they barely have any equity or other investments in their own company, meaning they're literally, they typically, when a company does a lot of buybacks and they increase their equity over time, that's a great sign, because they believe that their stock price is at a bargain, right? It's just a good indicator that the company believes in their company, okay? Now, their current assets as well are literally their negative cash flow currently. Are they, potentially positive cash flow long term? Let's see. a little bit over 11 million, so 11.1 million total assets. What's their total liabilities? Okay, 11.8 million. So they're negative, long-term cash flow as well. So this company, it literally hits all the major red flags. While the equity isn't negative, which you will see from time to time, so it's positive, but it's super, super low. Okay. Red flag. The retained earnings super, super low. Red flag, obviously it's negative, and they're both their current cash flow and their long-term cash flow is also very, very negative. So this is a horrible company. Now, if you guess this is SiriusXM, you would be correct, but obviously SiriusXM is on the radio, and with everything else going right now, like audio books, right, podcasting, the rise of video and all that stuff, there's so much opportunity now for other platforms and people to grab attention that obviously radio is dying. So SiriusXM, if you look at the financials and the balance sheet of that company, clearly struggling, not a company you want to look at. So that's kind of my outline of these companies. I really hope that it helped. That kind of is your introduction in looking and analyzing balance sheets. Remember these 3 things. If you need to download this PowerPoint, if you already haven't already, to kind of check these things, I highly recommend that you do. Go off, look at companies. The best way to learn is to look at them yourself. Do a checklist, right? Literally look at their balance sheet and go down. Do they have negative earnings? Do they have negative equity? What's their current and long-term cash flow situation look like?